Ladies and gentlemen, thank you for joining me today. I'm here not to repeat old forecasts. I'm here to change them because everything in the global financial machine is shifting fast. And what once seemed probable may no longer be valid. My entire gold and silver price prediction for October 2025 is being revised, not because I'm flip-flopping, but because new truths demand it. If you were depending on old forecasts, you may be dangerously unprepared. In this session, I will walk you through the new reality, what's changed, what to watch, and how to position yourself before the storm strikes. Let's start with the biggest pivot: monetary policy and the dollar's direction. The Federal Reserve appears to be tilting toward easing later in 2025 if economic growth slows. That means lower real yields and a potential softening of the US dollar. Historically bullish for gold and silver. But this pivot might come with surprises. A stronger dollar or a hawkish surprise could shatter complacent forecasts. The new baseline must account for that volatility. Next, technical structure matters more than ever. Gold is expected to trade between 980 and 400 in the near term. Silver may push past PAV $50 ton if bullish momentum holds. The economic times, but those are zones, not guarantees. If price breaks key support or resistance, the trend can snap hard. Always watch for breakout failures or fakeouts. Then there's silver's story. It's evolving on the demand side. Industrial uses are rising and supply is tight. This dynamic gives silver an asymmetric upside potential. In prior models, silver was lagging gold. That skew may invert now. Don't ignore silver just because your old models did. Institutional behavior continues to shape structural bias. Central banks and large funds are accumulating gold steadily. That's not retail hype. That's heavy structural demand supporting long-term strength. But even institutions obey markets. When sentiment turns, they can exit just as fast. Volatility and sentiment now act like turbochargers. Geopolitical risk, inflation surprises, or rate shocks, any of these can send gold or silver swinging violently. Leverage in ETFs and futures will amplify those moves. So this new prediction must respect volatility, not deny it. As models evolve, mine must too. Earlier forecasts were built on inputs like stable inflation, moderate rates, and a neutral dollar. But now those inputs are off. The next forecast must be dynamic, adapting to inflation spikes, bond market stress, or currency turbulence. I've rerun models with heavier weight to real yields and policy surprise risks. Finally, risk management. No prediction is flawless. When I change a forecast, I don't expect you to blindly follow it. You must size your risk, set stop losses, and avoid betting everything on one scenario. The greatest risk is overconfidence masked as conviction. The entire global financial environment in late 2025 is standing at a crossroads where the balance between growth, inflation, and monetary policy could define the direction of gold and silver for years to come. The first thing to understand is that macro forces, especially interest rates, Federal Reserve policy, and the US dollar's trend, are the dominant levers behind the price of precious metals. When these levers shift, the underlying assumptions behind every forecast must shift too. What looked like a solid gold bull run a few months ago can instantly turn uncertain if the Federal Reserve's tone or pace of rate adjustments changes. This is why I'm changing my outlook, not because emotion dictates it, but because data does. Throughout history, gold and silver have thrived when real interest rates, that is, the nominal rate minus inflation, decline. When money loses its purchasing power faster than bonds can compensate, investors seek assets that store value rather than yield it. In 2025, inflation appears more persistent than previously expected, while the Fed is under pressure to maintain credibility without choking growth. The market's anticipation that the Fed might begin cutting rates later in 2025 is creating a new path for capital to flow toward commodities, particularly gold and silver. Lower yields weaken the dollar, and a weaker dollar almost always means stronger demand for alternative stores of value. But this relationship isn't linear. It's full of shocks, reversals, and moments when liquidity trumps logic. The US dollar itself acts like a mirror for global confidence in American policy. When the dollar rises sharply, it usually reflects a tightening of global liquidity, meaning investors rush into cash and away from risk assets, including metals. When the dollar weakens, liquidity expands, and assets like gold and silver benefit. So, when I say macro forces are shifting, it's not just the Fed's rate decisions, but also how global investors interpret the dollar's message. At this stage, data suggests that the dollar could begin losing strength into 2025 as growth cools and deficits widen. This scenario forms a bullish base for gold and silver, but only if inflation doesn't fall too quickly. If it does, real yields could stay high, suppressing upward momentum in metals. Markets today are not purely driven by fundamentals. They're also driven by psychology and positioning. Many traders entered 2025 expecting a soft landing, meaning inflation under control and growth steady. But recent indicators are challenging that view. If growth stalls faster than expected, the Fed's pivot could come sooner, triggering the kind of dollar decline and yield compression that metals thrive on. The real challenge for investors is to identify these macro inflection points before the market fully prices them in. Waiting for confirmation often means missing the move. It's essential to look at gold and silver not as speculative plays, but as hedges against systemic risk. As fiscal deficits balloon, monetary easing returns, and the world moves toward more geopolitical fragmentation, precious metals serve as the anchor when trust in fiat systems begins to wobble. The coming months could bring short-term volatility, but that volatility is merely the market digesting massive macro transitions. Those who can understand the rhythm of interest rates, the behavior of the dollar, and the psychology behind inflation expectations will navigate this environment successfully. This is why, as macro conditions shift, predictions must evolve. Not because the market is irrational, but because it's alive. The third major factor behind this new gold and silver outlook for October 2025 revolves around the debt cycle and monetary tightening turning into easing. Every economic cycle is defined by how debt expands and contracts, and we're now standing at a critical inflection point. Over the past few years, global debt levels have surged to historic highs, surpassing $315 trillion according to the IMF, while interest rates have climbed to multi-decade peaks. This combination has created immense pressure on governments, corporations, and consumers alike. But what's coming next isn't just another adjustment. It's the inevitable shift from tightening to monetary accommodation, and that shift has profound implications for precious metals. Historically, gold and silver have performed their best during transitions, moments when policymakers realize they've tightened too much and liquidity begins to flow back into the system. We're entering that phase now. Central banks, led by the Federal Reserve, are beginning to face the limits of how long high rates can be sustained without breaking something fundamental in the economy. Signs of stress are already visible. Credit card delinquencies are rising, corporate refinancing costs have doubled, and several emerging economies are struggling under dollar-denominated debt. These symptoms often precede policy reversals, a pivot from fighting inflation to preventing recession or default. When that pivot happens, interest rates typically decline, liquidity expands, and fiat currencies weaken. This environment becomes fertile ground for gold and silver. Both metals thrive when real yields fall. That is, when inflation-adjusted returns on bonds and cash become unattractive. If inflation stays elevated even as rates are cut, investors will once again find themselves holding depreciating paper assets. That's when the move into hard assets accelerates, not gradually, but with conviction. Another dimension is trust erosion in monetary authorities. Each major economic downturn of the last century has been met with more intervention, more money printing, and more debt monetization. The consequence is predictable. every recovery demand or amounts of stimulus to achieve smaller results. This diminishing return creates a feedback loop where investors begin questioning the stability of the entire system. Gold and silver act as the mirror to this system, reflecting not optimism but skepticism. When confidence in central banks declines, the value of tangible stores of wealth tends to surge. In 2025, this feedback loop will likely intensify. The world's largest economies are running structural fiscal deficits, meaning they spend far more than they earn, and the gap is financed by borrowing. As rates remain elevated, debt servicing costs grow faster than GDP, forcing either higher taxes, spending cuts, or monetary easing. Politically, only the third option is feasible, and that means more liquidity, more currency debasement, and stronger demand for gold and silver as alternative reserves. Silver, in particular, stands to benefit disproportionately because it is underround relative to gold. Institutional investors and sovereign funds rarely hold it in significant quantities. Once the narrative around liquidity expansion takes hold, silver could experience a catch-up rally, potentially outpacing gold's percentage gains due to its smaller market size and higher volatility. So, this keynote is about recognizing where we are in the debt and liquidity cycle. The coming shift from tightening to easing is not a guess, it's a historical pattern. Each time liquidity floods back into the system, those holding real scarce, non-yielding assets are rewarded. This is why adjusting the outlook for October 2025 isn't simply reactionary, it's anticipatory. The economic machine is cycling again, and gold and silver are poised to respond exactly as they have for centuries, by preserving value when paper promises begin to lose theirs. Another key element shaping the updated gold and silver forecast for October 2025 is the shifting global geopolitical and trade landscape, particularly the ongoing de-dollarization movement and the emergence of alternative financial systems. For decades, the US dollar has held its dominance as the world's reserve currency, giving the United States unmatched power in global trade, sanctions, and debt issuance. But this dominance is now being quietly and sometimes openly challenged. Nations like China, Russia, India, and members of the BRICS alliance are actively seeking ways to settle trade in their own currencies or through gold-backed mechanisms. These actions, while slow and fragmented, are collectively altering the foundation of global monetary confidence. And that shift is directly linked to the future of precious metals. The more countries diversify away from the dollar, the more they need tangible assets to back their reserves. Historically, gold has been the neutral asset that bridges political divides. Central banks around the world, particularly in emerging markets, have been buying gold at the fast pace in over 50 years, according to the World Gold Council. This trend isn't accidental. It reflects a deep and growing distrust of paper currencies that can be manipulated through policy or sanctions. In 2025, as global tensions remain elevated, whether over Taiwan, Ukraine, or Middle Eastern energy routes, nations are prioritizing sovereignty and self-sufficiency, and gold plays a central role in that strategy. Silver, while not as widely held by central banks, is riding the same wave but for different reasons. Beyond its monetary history, silver has become strategically important for the green energy transition, used extensively in solar panels, EVs, and advanced electronics. This dual role, both industrial and monetary, positions silver uniquely in the current environment. When investors realize that geopolitical fragmentation will not only boost demand for gold as a reserve asset, but also for silver as a critical industrial input, prices for both metals could experience a synchronized surge. In such a world, confidence becomes the most traded commodity. When trust in political systems and fiat currencies weakens, gold and silver become not just investments, but instruments of protection. We've seen this repeatedly, from the inflation crisis of the 1970s to the financial crash of 2008 and the currency devaluations in emerging markets throughout the past decade. Each time, gold and silver served as safe harbors while paper wealth eroded. The difference in 2025 is that these pressures are global, interconnected, and amplified by digital systems that react instantly to every headline. As sanctions, trade restrictions, and political polarization deepen, nations and investors alike are preparing for a future where financial systems could fragment further. Digital currencies, CBDCs, central bank digital currencies, and gold-backed trade mechanisms could coexist, but they also signal uncertainty and transition. During such times, history shows that investors turn to what they can see, hold, and trust. Gold and silver have never defaulted, never gone bankrupt, and never needed a bailout. That's why they continue to stand as timeless anchors in a world that increasingly feels unstable. By October 2025, as these global realignments accelerate, markets will likely reflect growing anxiety about the sustainability of the dollar system and fiat money more broadly. Investors who recognize this early and position themselves accordingly won't just be hedging against risk, they'll be aligning with a deeper, more enduring trend, the global return to tangible value. Gold and silver will once again serve their historic purpose, not as speculative plays, but as insurance against the failure of trust itself. The fifth major element driving the reevaluation of gold and silver price predictions for October 2025 revolves around the psychological shift among investors and institutions, a shift from speculation toward preservation. What's happening now is not just about market charts or technical analysis, it's about a deeper realization that the global financial system is fragile and the behaviors of those within it are changing rapidly. Over the past few years, the average investor's mindset has evolved from chasing quick returns to seeking stability in assets that can endure inflation, policy errors, and geopolitical shocks. This behavioral transformation is what's quietly setting the stage for gold and silver's next major move. Throughout history, the markets have always been shaped by waves of emotion, fear and greed being the two strongest. In times of abundant liquidity, low interest rates, and economic optimism, greed dominates, pushing investors toward riskier assets like equities, tech stocks, or cryptocurrencies. However, in times of uncertainty, when trust in institutions begins to weaken, fear takes over, and capital starts flowing back into real assets. That's exactly what we're beginning to see again. Investors, from small retail traders to billion-dollar funds, are realizing that inflation may not be temporary, debt levels are unsustainable, and central banks' ability to control markets through policy is diminishing. This realization changes everything. Gold and silver are not just viewed as commodities anymore. They're becoming instruments of financial independence. Unlike stocks or digital assets, they aren't someone else's liability. They don't depend on a central authority's solvency or a company's quarterly performance. They are pure assets, immune to counterparty risk, and as confidence in the global monetary system continues to erode, this distinction is becoming central to the way capital allocates itself. Investors are starting to understand that wealth preservation is not just about returns, it's about resilience. Another factor amplifying this psychological shift is the accessibility of precious metals in digital form. The rise of tokenized gold and silver platforms, as well as ETFs and fractional ownership systems, is making it easier for the everyday investor to hold physical value without the logistics of vaulting or transport. This democratization of access means that even small investors, previously confined to fiat savings, are now diversifying into metals. When millions of people around the world begin making similar small moves, the cumulative demand becomes enormous. And that's exactly what's happening beneath the surface. Institutional investors are moving too. Hedge funds and sovereign wealth funds are beginning to revisit gold allocations that were largely ignored for a decade during the tech and crypto boom. When these large entities shift even a small percentage of their holdings into metals, it can trigger massive price moves. They are not doing this for speculation. They are doing it to hedge systemic risk. The awareness that paper wealth can disappear overnight while gold and silver remain immutable is becoming mainstream once again. This mindset change is not a temporary reaction to headlines. It's a structural adjustment in how investors perceive safety. As we move deeper into 2025, the narrative of diversification is turning into survival strategy. Investors are no longer asking, how much can I make? But how much can I keep? That shift in question marks the beginning of a long-term revaluation of tangible assets. By the time October 2025 arrives, and if global volatility continues at its current pace, gold and silver could experience a significant repricing, not merely because of inflation data or central bank policies, but because of this global psychological awakening. The markets are built on trust, and once trust begins to fade, people instinctively turn toward what they know will hold value regardless of political promises or digital volatility. This time, that collective instinct could drive gold and silver into one of the most important revaluation phases in modern history. The sixth factor influencing the complete reassessment of gold and silver price predictions for October 2025 is the rising geopolitical fragmentation and the acceleration toward a multipolar world order. For decades, the global economy functioned under a relatively stable system dominated by the US dollar. Trade, debt, and commodities all revolved around it. But as 2025 approaches, that foundation is shifting. Emerging powers are increasingly seeking autonomy from Western financial systems, forming new trade alliances, settling deals in local currencies, and building gold reserves as a strategic hedge against the dollar's declining dominance. This quiet but powerful realignment is reshaping how global capital flows, and it directly impacts gold and silver demand. One of the clearest signs of this shift is the renewed accumulation of gold by central banks worldwide. Over the past few years, they've been buying gold at the fastest pace seen in over half a century. The motivation behind this trend is simple. Trust in the dollar-based system is weakening. Sanctions, currency weaponization, and debt monetization have shown countries that reliance on one global reserve currency carries risk. Gold, on the other hand, offers neutrality. It belongs to no nation, carries no default risk, and cannot be frozen or debased by policy. This makes it the ultimate geopolitical hedge for nations that face external vulnerabilities or depend heavily on imports. Holding physical gold reserves has become a tool of sovereignty. The same logic is now filtering into the private sector, where corporations and investors are also beginning to think globally rather than locally. They are diversifying exposure not only across asset classes, but also across currencies and jurisdictions. This diversification at its core favors assets like gold and silver, which transcend political boundaries and remain universally recognized as stores of value. Another consequence of this global fragmentation is the strain it places on supply chains, especially for precious metals. Silver, in particular, is deeply tied to industrial demand, from solar panels and electronics to emerging technologies like electric vehicles and renewable energy systems. As trade routes become more politicized and as countries begin prioritizing self-sufficiency over global cooperation, access to critical materials could tighten. This creates an imbalance between industrial demand and available supply, dynamic that could drive silver prices significantly higher in the medium term. Moreover, the geopolitical uncertainty itself becomes a catalyst for investor behavior. Historically, whenever the world edges closer to conflict, sanctions, or financial decoupling, gold and silver rally as safe havens. Investors understand that during geopolitical crises, paper assets and currencies can lose value rapidly, while tangible assets tend to hold or increase in worth. The escalating tensions in 2025, whether economic, territorial, or political, are not isolated incidents. They're symptoms of a deeper transition in global power structures. The multipolar world that's emerging is inherently less stable and more unpredictable. Each region now pursues its own interests, often at the expense of global coordination. This fragmentation doesn't just threaten markets, it rewires them. For investors, it's a wake-up call that the era of predictable globalization is over and the era of fragmented, resource-driven competition has begun. In this environment, gold and silver play a critical role, not just as investments, but as anchors of confidence. They're the assets investors turn to when they can't rely on political promises, monetary stability, or global cooperation. As October 2025 approaches, the implications of this fragmentation are becoming undeniable. The world's financial system is being redefined, and gold and silver are quietly reclaiming their historic place at its foundation. Those who recognize this shift early will not only preserve their wealth, they'll position themselves for the opportunities that follow in a world built on new financial realities. The final reason behind the change in gold and silver price predictions for October 2025 lies in the psychological and behavioral transformation of investors. Over the past few years, markets have been driven more by emotion, expectation, and narrative than by fundamentals alone. This shift is crucial because precious metals like gold and silver are not just commodities. They're reflections of collective sentiment about trust, stability in the future. As inflation fears, currency devaluation, and debt anxiety rise, investor psychology is tilting decisively towards safety. Yet the way this psychology operates in 2025 is different from any other period in modern financial history. In previous decades, investors often viewed gold as a last resort, a static asset to hold when everything else failed. But now, gold and silver are being reframed as dynamic parts of a modern portfolio. They are not just crisis hedges, they are strategic allocations against long-term systemic risk. The widespread access to financial education and global data has made investors more aware of macroeconomic vulnerabilities. Retail and institutional investors alike are recognizing that the current global system, built on debt expansion and easy monetary policy, has reached its structural limits. This growing awareness is creating a new wave of proactive hedging, where people aren't waiting for the crisis to hit, they're preparing before it arrives. Social media and digital platforms have accelerated this change dramatically. Unlike past economic cycles, information now spreads instantly. Market sentiment can shift in hours, not weeks. This means fear, greed, and speculation all move faster, and precious metals respond almost immediately. When investors hear about central banks printing trillions, or when headlines flash about a potential market crash, the reaction is no longer delayed. They rush towards safe assets. This collective behavior, amplified by online communities, creates powerful surges in demand for gold and silver ETFs, coins, and bars. However, this fast-moving sentiment is a double-edged sword. While it can drive prices upward quickly, it can also create volatility as investors overreact to short-term news. What's important to understand is that beneath these emotional waves lies a deeper, more durable shift, a structural loss of confidence in fiat money. People no longer believe that governments can print their way out of every crisis. They've seen the purchasing power of currencies erode, housing prices soar beyond reach, and interest rates whipsaw unpredictably. In that environment, gold and silver serve as emotional anchors, symbols of something real, tangible, and lasting. The psychological aspect also extends to institutional decision making. Hedge funds, sovereign wealth funds, and large asset managers are beginning to allocate more to metals not out of speculation, but because they understand the sentiment of the market itself. They see where trust is moving, and they follow it. The movement toward tangible value is no longer just a defensive strategy, it's becoming a mainstream investment philosophy. By October 2025, the alignment of sentiment, narrative, and action will likely push gold and silver to new levels. Investors, both large and small, will act not merely out of fear but out of conviction that these assets represent truth in a distorted financial world. The psychology driving the market is no longer about chasing yield, it's about preserving certainty in uncertainty. This evolving mindset is perhaps the underestimated driver of what's coming next. Economic cycles, policy changes, and geopolitical shifts can all be analyzed with data, but human psychology remains the ultimate wild card. When collective trust shifts, markets transform overnight. That's what's happening now. A quiet revolution in perception. Gold and silver are no longer relics of the past. They are becoming the emotional core of the future financial system. The smart investor sees this transformation not as a short-term trend, but as a generational turning point in how the world defines value, safety, and wealth itself.